week's important dialogue that I would like to share as the ETF program mentor is all about risk profiling. And one of the important elements with regards to risk profiling is understanding what is your individual approach to investing. So when we look at the conservative investor, and I've pretty much named a few characteristics of each of the investor types or risk profiling types, and it very much is very individual to every single student that is going to be progressing forward with regards to what type of ETF structures would they choose, and what type of ETF structures they are going to choose. Are they going to be relevant to the actual and final objective of growing the profitability and the returns within that particular ETF? So when we look at conservative investors are always looking for long-term capital preservation. And the word preservation means that if I'm going to be putting 10,000 Rand as an investment into any investment, including an ETF, preservation means I would like to keep that 10,000 Rand intact without any volatility. In other words, any reduction or risk of reduction of that 10,000 Rand for the duration of my investment period. So when we look at the basic interpretation of investing, often the very, very first step, what strategy am I going to impose to ensure that my capital is going to be preserved and kept intact as a starting point with regards to my investment time horizon? So in other words, when I talk about time horizon, and I'm just making a little bit of terminology a little bit more clear for everyone, when I talk about time horizon, remember that this competition effectively ends towards the end of November. So what you want to be able to do is you need to ensure that you don't basically go and invest in a particular ETF with the risk of losing your invested capital from day one over the duration of the competition. Conservative investor is therefore insulated from extreme volatility, very little potential for growth in value. And the reasoning behind the growth in value limitation is that the main aim or the main goal for this particular risk profile is to preserve and to keep the initial capital exactly the same. And as a main objective, preserving that capital right to the very, very end of the investment. Investing in well-established companies, in other words, not taking a chance on a relatively new company that might increase the risk exposure and therefore increase the risk of losing your hard-earned money over that time period. And conservative investor, if I can just put it into context, is not a low risk strategy. Okay, it is not a low risk, low return strategy. It means that you could well choose a number of conservative funds that are available on the ETF platform and still have a positive growth. So it doesn't mean that you are taking a low risk strategy and therefore expecting a low return at the end of your analysis. Okay, so remember that we are going to be looking at students that are going to be investing in a whole number of ETFs, and I'm going to be shortly going and sharing a slide with you from the from the login page, just to show you what type of information might you be looking at in order to understand the type of ETF that you're going to be investing in, and obviously with the main aim of diversifying your investments using your 100,000 Rand to basically spread across all the various different risk profiles. Right, if there are any questions, as I say, please feel free to contact me if you feel that you just need a little bit more clarification as to what type of strategy you're going to be using or are using at the moment. Then please feel free to contact me. All right, let's have a look at the moderate investor and moderate risk profile investor, looking for both income and growth, capital growth. So in this particular context, the moderate investor, somebody that we are always defining as somebody who is right in the middle, in between conservative and aggressive. The moderate investor is looking for capital growth. Remember the word capital growth, which is effectively step number 2 of most investment strategies. Capital growth means that I'm looking to grow my initial capital invested with a return, and from that return, I'm looking to basically have an income distributed back to me, either in the form of dividends or in the form of interest. So that obviously depends on the type of investment that you are investing in. The portfolio tends to be less volatile than the market as a whole. And the word portfolio in this case tells the investor what choices in this case of exchange traded funds that particular investor has chosen in order to make up their investment strategy. So for example, you could choose 2 conservative, 2 moderate, and 2 aggressive ETFs. That's 6 different exchange traded funds, and therefore those 6 funds would make up your portfolio and would also make up the type of returns that would be basically averaged out using your 100,000 Rand demo account. Okay. Moderate investors will pursue long-term growth. The word or the term long-term often alludes to a time period of 5 years or more. Okay, 5 years or more, and the reason for that is that, remember, we have got volatility, we have got a lot of various global and local circumstances that are going to affect the actual growth within that 5-year time period. And so your portfolio needs to absorb all of the losses and give it time in order to recover and recuperate all those losses and to show capital growth. The moderate investor is looking to grow their money without losing too much. In other words, not losing too much on the capital. And a moderate investor therefore needs to tolerate some losses, which tend to be temporary. So as mentioned before, your long-term objective in this particular risk profile is to certainly ensure that we might go through a 6-month period of losses, but over the total duration of, let's say, the 5-year term, we're able to absorb, recover, and see a capital growth with the remaining time that is left on that time horizon. And then the third, and pretty much maybe one of the most misunderstood risk profiles, is the aggressive investor. An aggressive investor is looking for a high level of aggressive growth. Now, the word aggressive means different things to different people. So I might be the type of investor that is risk adverse, which means I don't really like to take risk, which means that me investing in exchange traded funds actually is an aggressive change in my strategy. So one just needs to be careful and to take into account that each and every one of us will interpret these risk profiles differently. And that's really the beauty of the competition and the challenge, in that all of you will have a lot of trial and error, a lot of learning curves that you will experience, because you will have a perception that you are being aggressive in nature, only to surmise that your returns have actually been evaluated as moderate or conservative. Okay, so it'll be important to understand why, if that does happen, why that did happen. The portfolio, remember, the number of exchange traded funds that you choose can be highly volatile in this particular risk profile category, and that is resulting in the investor requiring a long long-term approach. Now, for a lot of aggressive investors, there is a timeline of around about 10 years or more. Okay, 10 years or more. If I look back just from the last 10 years with regards to the investment platform in general, we are able to ascertain that over the last 10 years, if we go back to 2012, we had a bull run, and a bull run means that effectively equities and the markets were performing very, very well. We had a bull run for around about 3 to 4 years, followed by a bear market, and a bear market means that the returns and investments are under extreme volatility, and therefore the returns have been very marginal, if not negative. So a long-term approach, for example, is 10 years plus. You are able to absorb all of the negative losses and all of the appreciating gains, and obviously average out your returns over that time period. So typical of investors in this profile, they need to have a fair understanding of markets and shares. And in the future, if you are going to follow this type of risk profile, you need to have quite a clear understanding of the type of shares, the type of markets that you're going to be investing in order to have some form of success. This is definitely not a hit and this type of situation. Right. Therefore, when we look at all three risk profiles, the name of the game is diversification. And diversification is based on the premise that all investments carry a particular risk. Every single investment, including every company that has been chosen within the exchange traded fund platform, will carry a particular risk. Therefore, when you spread your money among a variety of different investments, you can potentially limit or reduce the risk. As one increases the number of shares in a portfolio, the riskiness of that portfolio declines. And one of the main principles of diversification is encapsulated with that particular point, because as you, the investor, increases the number of trades or shares or ETFs to your portfolio, there is a great possibility that, given the fact that you do choose and diversify in the correct ETF structures, that you will reduce the riskiness of your overall portfolio. So the beauty of this competition is that ETFs allow diversification by investing in a mixture of different asset classes. And asset classes, one just needs to understand that there are a number of asset classes that are included in exchange traded funds that include cash, fixed interest, and equities. And when one asset performs poorly, the diversification allows the remaining assets to hold their value. So always remember that if one particular ETF fund is not performing well, do you go and sell it and invest the remaining portion of your balance into another ETF? An interesting question for you to maybe think about and research. The answer will lie in the previous 3 slides when we looked at risk profiling. What type of investor are you? If you're aggressive, you might want to leave that particular exchange traded fund and see if it does appreciate with the time remaining for example, for the competition. Okay, so in summary, the competition investment strategy. A lot of students will start asking the question, what type of strategy should I maybe look to implement? And again, I must advise that Easy ETFs on the Easy Equities platform, there is a risk profile tab that you can access that allows you to invest in your conservative, moderate, and aggressive funds. And I'm going to be sharing that screen with you in a moment, just to make 100% sure that everybody knows exactly where those particular tabs are. But it is very, very important to basically consider a split of your 100,000 Rand virtual money. in the understanding that your risk profile, the risk profile that you're adopting, don't take that risk profile adaptation or interpretation as too serious. Okay, there is going to be a lot of trial and error. That's what the competition is all about, for you to basically find out what works for you, what doesn't work for you, and most importantly, why. Why would that particular fund or your interpretation of that fund provide such a positive return? And on the flip side of the coin, with regards to certain decisions made on another fund, why did they produce such a bad loss for you? Okay, so those are really the questions that I'm excited to answer going forward. But remember, diversification is the name of the game. Do not throw all of your money or put all of your money into one basket or one pot. Okay, don't put all your eggs in one basket. Have a look at the various ETFs that are on offer across the various profiles, and make sure that you don't put everything into one particular risk profile, and have a look at the returns. Have a look at the weekly or the bi-weekly returns, just to give yourself an understanding of that. Right, thank you. Okay, so that just gives a basic indication of the various risk profiling categories. And next, I'm going to share a screen. And if you can please just let me know that if I could just if I can just ask one of the ladies, Shamola Josima, can you see the screen at the moment? I assume that it has come through. Good. Okay, so remember that this is basically the screen that you will log into, and that will give you, obviously the access details will be specific to your particular investor profile. And I'm just going to log in quickly, but obviously at this stage, if you haven't accessed this slide before, you would put in your login details. And you would have verified all of these details directly with Easy Equities. So I just want to just log in. Your username and password will, okay. All right, we'll take you through to a screen that looks like this, and it's going to basically give you your Easy Equities, and you'll see right in the middle at the top of here, it will say your demo ZAR. Now that's where obviously your funds are going to be invested from. Okay, so you will have a running balance with regards to from your demo account. All right, and once you click on that particular demo account, it will take you through to a screen that has got some filter options. Okay, some filter options, and you will see that right on the top bar, you will click on ETFs, because that is what the competition is basically based on. And you will see that just underneath that particular block over here, you will see all of the different types of risk categories. So you'll see risk low, risk conservative, risk moderate, moderate aggressive, and aggressive. Now remember, the information that I've shared today just gives you an indication of how you might implement your strategy across all of these. And remember, diversifying across all of these will be at your will be left to your intuition, if I can put it that way. There is no right or wrong way with regards to the investment strategy that you choose. That is going to be completely dependent on yourself. Okay, so I'm going to go straight to the moderate tab, and I'm going to click on the moderate risk tab. All right, and it's going to bring up, once I've clicked on the moderate risk, it's going to bring up a whole suite of different exchange traded funds that are available for you to invest in. Okay, now Dependent on the type of investor, it is always important to do a little bit of research. Obviously, you don't just click on the first one that comes to mind, but you want to just do a little bit of research with regards to maybe the companies and obviously the type of choices that might be prevalent with regards to the company's exposure and obviously the company's performance in general with regards to exchange traded funds. Okay, so for example, once you have made, and it's important to do a little bit of research. Remember, the competition is based on students evaluating what type of companies and what type of funds might be the best options for them. So it's very individual in nature. Okay, all right, so I'm going to, let's say, click on Satrix, the South African bond ETF. All right. And once you click on the ETF, you will see a whole lot of information that is basically come up on the screen. And just to give you a basic idea of the information that is at your disposal, confirmation of the name of the ETF at the top, confirmation of the risk grading, and then you will see that right in the top corner over here, it says 1 month return, and you'll see that there's a negative 2.03% return for the last month of trading. The daily change, okay, daily change in relation to investments and returns are a negative 0.36%. And you'll see here a very important set of information next to the zoom level. And I'm just going to click on the important aspects that you might want to look at over the last month. So the 1M stands for month, okay? It shows you the performance right at the bottom on the bottom axis. It shows you the various performance month on month, all right? Month on month from August, and it goes across a variation of days for that particular month. And on the vertical axis, it shows you basically the share price. What has happened to that share price? How has it fluctuated? And one can see over the last month for this particular ETF, there has been a gradual and a gradual reduction in the fee in the performance of the fund, to the point that we can see that basically starting just under 8.40 Rand, that this particular fund has reduced all the way to just above 8.21 Rand, to about 8.21 Rand. So there has been over the last month a steady decrease, and that is basically summarized as your negative 2.03%. Then you can go to 3 months. So you could click on the 3M button, which will give you an indication what has happened over the last 3 months. There's the timeline at the bottom, and also obviously the share price on the vertical axis. And it gives you a much better indication over the last 3 months what has happened with regards to the volatility. Okay, the volatility of this particular exchange traded fund. And one can see that the more zigzag this particular interpretation is, the more volatile this particular share is. And you can work your way across all the way through from 6 months, all the way to 6 months, all the way to 1 year. Now, I am a big fan of using the 1 year, this particular slide, as a part of my evaluation, because if I look at the last year, which arguably does build in enough time for slight volatility to be absorbed, I can see all of the different trading prices. If I just hover my cursor over any one of these various points on the graph, it will show you what was the trading price of this particular exchange traded fund and the basket of shares that it's invested in over the entire time period. This will give me a very good indication. If I started at around about 8.27 Rand, currently over the last year, it's trading at around about 8.24 Rand. So I've got a negative return of 0.73%. So technically, remember we spoke about capital preservation. If I had invested 10,000 Rand a year ago, I would have a negative 0.73 reduction on that 10,000 Rand. So arguably, the capital preservation objective has not been met, and there has not been any capital growth either. So my next question comes in, do I take a chance? Do I go in at this level and hope that the performance is going to increase? That will again depend on your risk profile. On the right-hand side of the screen, it basically shows you what is the share selling at. So you would sell at R8.15, you would buy at R8.20, and the last trading price is R8.21. Okay, so that will give you a very good indication. If I had to buy and sell within a short time period, what would be my aggregate loss or return, which will obviously then summarize the 1 year return on the left-hand side of that particular graph. All right, just underneath just shows you that for me personally, how much money I've got left to invest. And if you want to invest in the ETF, you simply go and invest your amount here. You click on there and you'll say 10,000 Rand, for example, and you would then go a once-off trade. Okay, all right, so I'm going to take that out. So just to show you the investment amount, and then right at the bottom of the screen, all right, please just make a note where it says our research. Okay, it comes up with a lot of information with regards to what has been researched on the Easy Equities platform. Okay, on the Easy Equities platform, please just make a note that there is no indicative information. This little tab over here, our research is more opinionated around the market performance. So please don't go and use that as a prompt for you to either buy or sell into that ETF. But what you could also do is that you could go and Google this particular exchange traded fund, and you could also go and research the company, which will give you a little bit more information with regards to what kind of picks you would take. All right, so that just gives you an indication of, if you haven't traded yet, what type of information you should basically be looking at: the returns, the daily changes, the performances over various time periods, 1, 3, 6 months, and a year. And I would look at that as an indicative, indicative amount of information with regards to what would you look at, how would you diversify your funds moving forward from there. Okay, once you start trading, it'll become a lot more easier for you to amalgamate all of the information that you have researched into your particular trades. All right. Okay, so that pretty much concludes the presentation for today. So I'd like to just obviously open the floor to any questions that anybody would have. Okay. All right. Okay, so yeah, so for everybody, please, every single Wednesday, Meridian hour, 12 o'clock, we'll be sharing new and exciting information, and obviously there'll be a lot more questions being asked, resulting in a lot more feedback being given. So please join us next Wednesday at 12 o'clock for the next exciting theme that we're going to be sharing. But otherwise, to everybody, thank you for joining in. Thank you for listening to the recording once you do listen to it, and look forward to connecting with you next Wednesday. Okay. All right. Thanks, everybody. Have a great week. Good luck for all your tests as well, by the way. Okay. Shamola and Jasima, thank you so much. I appreciate everybody joining in and listening as well. Okay, great. Have a great week further, guys.